earn £197 in a week and lose over £4,000 a year in benefits. That's the brutal reality of the carer's allowance earnings trap. Thousands of carers are walking this tightrope every single week, terrified of accidentally crossing a line that could cost them everything. This isn't a mistake or an oversight. This is how the system actually works. Hit that like button, subscribe for more benefits advice, and drop a comment below telling us if you're claiming carer's allowance right now. Here's what's at stake. Carer's allowance pays £83.30 every week. That's over £4,300 a year. But there's a cliff edge built into this benefit that's caught thousands of people out. Go just £1 over the earnings limit and you don't lose a portion of your allowance. You lose the entire thing. In this video, we're going to break down exactly how this earnings limit works, the 4 ways you can reduce your counted earnings to stay eligible, and crucially, the major changes coming that could help 60,000 more carers qualify between now and 2030. Plus, there's a game-changing detail about allowable expenses at the end that most carers don't even know exists. The first thing you need to understand is what the earnings limit actually is. From April 2025, you can earn up to £196 per week after certain deductions and still claim carer's allowance. This is a massive increase from the previous limit of £151. It's the biggest jump in the earnings limit since carer's allowance was introduced back in 1976. What this means in practical terms is that carers can now work up to 16 hours at national living wage and keep their benefit, and that works out to roughly £10,192 per year. But here's where it gets tricky. That £196 is after deductions, not your gross pay. Understanding what gets deducted before your earnings are counted is absolutely crucial. So let's talk about the first way to reduce your counted earnings. The first deduction is the obvious one: tax and national insurance. And these come straight off your payslip automatically. If you earn £220 gross, but £30 goes to tax and national insurance, your counted earnings drop to £190. You're still eligible for carer's allowance because you're under that £196 threshold. This is why it's so important to look at your net pay after tax, not your gross salary. Many carers think they earn too much when, actually, after deductions, they're well within the limit. Always check your actual take-home pay after tax and national insurance have been removed. The second deduction is pension contributions. You can deduct 50% of any pension contributions you're making. This applies whether it's an occupational pension through your employer or a personal pension you've set up yourself, and let's say you pay £100 per month into a pension. You can deduct £50 from your weekly earnings when calculating eligibility. Spread over 4 weeks, that's £12.50 per week knocked off your counted earnings. It might not sound like much, but when you're dancing on the edge of that £196 limit, every reduction counts. This is one of those details that can make the difference between keeping or losing your benefit. The third way to reduce your counted earnings is through work-related expenses. This includes things like specialist clothing you need for your job, necessary work equipment, and travel costs between different workplaces. If you're self-employed, you can deduct business costs that relate exclusively to your work. These need to be genuine work expenses, not general living costs. For example, if you're a care worker who travels between clients' homes, those travel costs between workplaces can be deducted. If you need specific protective clothing or equipment that you have to buy yourself, that counts too. Keep detailed records of these expenses because you'll need to show the carer's allowance unit what you're claiming. The key thing to remember is these deductions apply before your earnings are calculated for the £196 limit. Now here's the fourth way to reduce your counted earnings, and this is the one most people don't know about. Well, if you pay someone to look after either the disabled person you care for or your children while you're at work, You can treat those care costs as an expense, but there's a specific rule. You can deduct up to 50% of your earnings as care costs. The person providing the care cannot be your spouse, partner, parent, child, or sibling. It has to be someone from outside your immediate family. Let's work through a real example to show you how powerful this can be. Imagine you earn £250 per week gross. After tax and national insurance of £40, you're down to £210. You pay £100 per week for childcare while you're working. Under the 50% rule, you can deduct £50 as an expense. That brings your counted earnings down to £160. You're now £70 under the limit and fully eligible for carer's allowance. Without knowing about this childcare deduction, you'd think you were £14 over the limit and wouldn't claim. That's the difference between getting over £4,000 a year or getting nothing. The resolution here is understanding that these deductions stack together. You don't have to choose just one. You can combine tax, national insurance, pension contributions, work expenses and childcare costs all at once. Each deduction brings your counted earnings down further below that critical £196 threshold. Carers who understand these rules are protecting their benefit entitlement and maximising their ability to work. Those who don't know about these deductions are either restricting their working hours unnecessarily or accidentally going over the limit and facing devastating overpayment demands. The system is finally moving in the right direction. The earnings limit is now linked to the national living wage, which means it should rise automatically in future years. This change is expected to help 60,000 more carers become eligible for the benefit between now and 2030. Now here's that game-changing insight we promised. If your earnings fluctuate from week to week, the Department for Work and Pensions can average them out over a recognisable cycle of work or over 5 weeks. This means if you have one week where you earn £210 but other weeks where you earn £170, they don't automatically cut your benefit for that one high-earning week. They look at your average over a reasonable period, and this is absolutely critical for carers on 0 hours contracts, those doing agency work, or anyone with variable hours. Contact the Carers Allowance Unit to discuss your specific situation and make sure they're calculating your earnings fairly. This averaging system could be what keeps you eligible, even when your pay varies week to week. Like this video if it's helped you understand the Carers Allowance earnings limit. Subscribe for more guides on benefits and financial support for carers. Comment below with any questions about your own situation. We're here to help carers navigate this complicated system. Next week, we'll be covering what happens if you accidentally go over the earnings limit and how to protect yourself from overpayments.